So, here's what we've been looking at. Ever since, let's see, February, we've actually been in pretty much a sideways market. It's been boring, it's been annoying, we've been losing money, or at least I've been losing a good bit of money, or not making as much as I'd like to. But regardless, we don't know what the market's going to do. Around mid May, I said we're about to have a large downswing in the market. And hey, I was right, thankfully. And we did have a large downswing. It actually took us down to let's go to the moving averages and show you for all the major indices. Here's the 200 day. It took us right down to the 200-day moving average, that little red line right there. Take a look at the next index, NASDAQ. That one actually broke through the 200-day moving average. And finally, the Dow Jones Industrial Average, which always seems to show a lot of strength in times of fear because they have all the quote-unquote blue chip stocks. So, according to my post, we said that the market's been going sideways. It's somewhat bottomed out. Still hasn't hit our target yet, but it has bottomed out. Might have stopped short. We've had a couple days of rallies, even though they've been about half-hearted. Like, take a look at this low volume today. That is pathetic. We're having half-hearted rallies. Indicators are all saying that now might be a good time to buy. Maybe. Just maybe. The stochastic says that we should have bought like 4 days ago. And if we... No, 5 days ago. And if we would have been losing money. So it's giving us bad signals. So what do? We do a little something that's called a ratio spread. So this one will protect us from any downside. If the market goes down, even like if it goes down 50%, we're still going to make money. If it goes up a little bit, we're going to make money. If it goes up a lot, that's when we're going to lose money. So we're going with the options for the S&P 500. Let's try. A ratio spread is basically, I'll just give you some background. It's when you buy an in-the-money option and you sell two out-of-the-money options. So say right now, look where my mouse is. SPY is trading at 127.70. An in-the-money option would be somewhere close to that price. So let's say, how about 127 or 128, depending on which one is priced better. An out-of-the-money one would be, since we're going to be doing calls, not puts, and this is option lingo, so I'm not going to explain it on this, but I'll put some links to show you what kind of options there are. An out-of-the-money one would be, say, 130. First, let's evaluate. Where do we expect SPY to go? Its last top was just a little over 135. We could go with 132.50 if we wanted to. Well, we'll just say 135. And we don't care how low it goes because we're going to be protected. So we're going to go about 3 months out, take the September calls, and this is an option chain. They can give you a headache if you don't know what you're looking for. Okay, we're looking on this side where the calls. This side has puts. We really don't care about that right now. So where's our in-the-money one, and what's the volatility that's trading at? Alright, this one versus this one. No really crazy things going on with volatility, but I'm just going to buy the 128 one anyway. So we buy one call at 128. Now the out-of-the-money one, we're going to, let's see, we didn't expect it to get above 135, and since we're going to collect some premium on this, we're going to sell, let's go with, we still want one that will give us a good price. Let's see, let's try 132 and see what that gives us. So we sell two of the 132s. and you can see my positions down here at the bottom of the screen. The green, I'm buying that one, and I'm selling 2 in the reds. Take a look at our risk profile for the trade. We're going to use probabilities and see what our probability of success and failure are. We're going to set the slices to break even. And this trade, first, notice this. This trade has potentially unlimited loss. So we don't want the market to go high very quickly. But then again, this trade, no matter how low the market will go, see, even if the market goes down to like 0 or whatever, we're going to make $26 no matter what. Now what we want to happen is we want the market to go up just very, very slowly. So say it gets up to 132. That'd be perfect, because that means our 132 calls will expire and our 128 call will actually be worth something. We'll make the maximum amount. We'll make $425. That is what we want when it expires. So we basically need to hold this position until September. And we see the probabilities right here. 76.79% chance of success, 23.21% of failure. This would be a good idea. Over summer, which I still think is going to go sideways, we could see what happens, and in the meantime, say the market does go down a lot, what happens when time passes when the market goes down? Let's take a look. We'll jump to 1 month from today. And if the market goes down, we're still making money. So it's risk-protected spread. You just got to make sure that you're guarded on this at your break-even point. Like our break-even point is 136.27 here. So just to be safe, because unlimited risk does not appeal to me, just to be safe, if the price of SPY goes above 136.27, exit the trade with a loss. Just do it, because look, we can be losing thousands and thousands and thousands of dollars on this trade if we don't manage our risk. Alright, I know this was an advanced topic, so if you do have any questions, please post in the comment box. I tend not to do options that much, so I won't make a habit of it. Don't worry. Thanks for watching.